there are significant differences between cash flow and accounting, and you have to understand the two differences. Now, most contractors have experienced that difference between cash flow and accounting firsthand at least twice a year. The first time you experience it is usually about the November-December time frame. We go sit down with our accountant or our CPA, and we do a little bit of year-end tax planning. And if we're having a good year, one of the bits of advice they give us on a regular basis is, you better go spend some money. You need to spend some money or you're going to get nailed with taxes. Right? So we go out and buy a new truck or we buy equipment, right? Just to try and burn up some cash, or at least supposed cash, right? That's that first time we experience it firsthand, because in the back of your mind, you're kind of wondering, okay, if I'm making all this money, where is it? Right? I don't see that cash, but my accountant's telling me I have to go spend some money. The second time we experience it firsthand is usually about March 15th, tax time again. We go sit down with our accountant or CPA one more time and they tell us, well, hey, John, you've had a great year this year. Here's what you owe in taxes. What's your response to that? Right? Chances are it's, oh my goodness, if I made that much money, where is it? Because it's not in the checkbook. First-hand difference between cash flow and accounting. You're seeing it on a first-hand basis. Now, there are two major differences between cash flow and accounting. The first, think about it, first, cash flow deals with the real dollars that are flowing into and out of your checkbook on a regular basis. Accounting tends to deal with paper dollars or numbers on a sheet of page that really sometimes don't even mean anything to us. And so those two major differences that you will see, first, equipment replacement cost versus depreciation, and the second is how loan payments are handled. Let's look at those just a little bit closer. First, equipment replacement cost versus depreciation. Depreciation is an accounting thing. Depreciation deals with how much we paid for a truck 2 or 3 or 4 years ago. Equipment replacement costs, on the other hand, is a cash flow thing. And that deals with what it's going to cost to replace that same truck 2 or 3 or 4 years from now into the future. And we're going to build that into today's pricing. Yeah, again, it's a very real expense. Your typical equipment replacement costs, what it's going to cost you to replace your trucks and your major pieces of equipment in the future, will typically be 25 to 35% more than the depreciation that will show up on your profit and loss statement. So right there, we're actually underreporting your expense, your cost of doing business, and we're showing that your actual profitability is 25% higher than it really is. Again, typical equipment replacement costs are 25 to 35% higher than the depreciation that you're able to write off. Now the challenge is, what does that depreciation do for you when it comes time to replace your trucks? Absolutely nothing. It's not like you can take your depreciation statement down to your local dealership and say, here it is, what do you give me? Right? It does nothing for you. It's purely a tax thing. It's purely an accounting item. Right? We have to focus on cash flow. We have to build what it's going to cost us 2 or 3 or 4 years from now to replace those trucks into our pricing today, so we have the money when it comes due. The next thing that we have to talk about is a budget. Now, easily 95% of contractors across the U.S. and Canada do not put together a budget for their company, but you have to have one in place. This is one of the financial tools that you need to use to basically check the health of your company. There's a lot of different reasons companies don't put them together. I don't have time. I don't know how. I'm not going to use it anyway. How do I know what's going to happen next year? The list goes on and on. Right? But here's the thing. This is one of the tools that you need to measure the financial health of your company. As I said, you need to have it in place. Now, we'll look at a very simplified budget here. Right? So for my little company, and you can put as many zeros on these numbers as you would like. We start out, the first element that we have to have is the actual projected sales. We look at that part of the puzzle. And if you don't know what you're going to have for sales next year, don't worry. Nobody does. But you do know what you did for sales last year. Right? And we think about it. If we lost money in January, February, March last year, and we lost money in January, February, March the year before that, and we lost money in January, February, March the year before that, what are the odds we're going to lose money in January, February, March of this year coming up? It's pretty good. Right? So use that as your guide. Right, so we start out projected sales, right? So I can see in January I have 2,000, in February is 1,000, and March is 3,000, and then April is 12,000, and 30, and 25, and so on down the year. what's the first thing we notice about the sales in our company? They're seasonal. Right? We've got ups and downs throughout the year. Most every company has that. And then the next element is our cost of sales. Now, this is very simplified. So this is not only the cost of the job, but it's all overhead expenses combined. And so we see in January, $6,000 in expenses, February, $5,000, $7,000 in March, $10,000, $20,000, right? And again, we have the seasonality. And so that brings us with our net profit and loss for the company for the year. And again, this is from a cash flow basis. So we start out in January, I can see we lost $4,000. In February, we lost another $4,000. In March, we lost another $4,000. Right? And then we made $2,000 and made $10,000 and made $7,000 on throughout the rest of the year. So a properly put together cash flow budget needs to have this last line on here. It's the cumulative profit and loss for the year. It's basically, if you will, your checkbook balance for that point in the year. Right? So I start out in January, I'm at minus $4,000. In February, I'm now at minus $8,000. In March, I'm now at minus $12,000. Right? In April, minus 10. It's May before I finally break even, right? And June before I have any positive cash flow. Does that look at all familiar? Of course it does. The only thing that changes is when that negative portion of the year hits. Right? So we have to have that in place. There's a couple of elements here that are really important. Number one, if I look at the end of my year, I see we finished out the year at plus $17,000. Now that plus $17,000 means absolutely nothing if we went out of business back here in January, February, and March. We have to plan for the year. We have to plan for our cash flow. Now, one of the things that will happen throughout the year is, again, remember, usually about November, December, we go sit down with our accountant and they may see that positive balance and say, well, you're having a good year. You better go spend some money. Now, the problem is, should I spend this money now? If you think about it from a cash flow perspective, right, I've also got minus $3,000 here in December, right? So we've got a negative month there, and chances are we got a bunch of negative months coming up here. I better carry some of that cash over to the next year. So your accountant isn't giving you bad advice. They're purely giving you accounting advice. Right? In fact, sometimes your accountant will tell you, don't worry about next year, we'll worry about that next year. Right now, let's just take care of this year. The problem is you have the same checkbook balance on January 1st that you had on December 31st. You have to run your basis on a rolling 12-month basis looking at the cash flow of your company. We better carry some of that profit over to the next year to help us get through that negative period in time. Plan your cash on a month-by-month basis.